March 27th, 1980, Silver Thursday. The day the global silver market imploded. Prices collapsed 50% in a single day. Billions of dollars evaporated. Major banks teetered on the edge of bankruptcy. And at the center of it all, two Texan billionaires who thought they could control 1/3 of the world's silver supply. But here's the twist nobody saw coming. 45 years later, in 2025, silver just hit record highs above $65 per ounce, shattering all previous records. The metal that was supposed to be dead is now outperforming gold, Bitcoin, and virtually every major asset class. So what happened? How did silver survive the biggest manipulation attempt in commodity history? And more importantly, why are the world's largest banks still fighting to control it? This is the untold story of silver's resurrection. And trust me, it's far more dramatic than you think. Let's rewind to 1973. Nelson Bunker Hunt and his brother William Herbert Hunt weren't your average traders. These guys were Texas oil royalty, sons of Harrelson Lafayette Hunt, one of the richest men in America with a $5 billion fortune. But even with billions in the bank, the Hunt brothers saw something most people missed. The US dollar was in trouble. The Nixon shock of 1971 had just killed the gold standard. Inflation was spiraling out of control. The Arab oil embargo was sending energy prices through the roof. And the Hunt brothers had a theory. If the dollar collapsed, people would rush into precious metals. But here's the genius part of their plan. Everyone was buying gold. Gold was expensive, trading around $400 per ounce. Silver? Silver was trading at less than $2 per ounce. The Hunt brothers saw an opportunity. They believed silver was massively undervalued compared to gold. Historically, the gold to silver ratio had been around 15-1, but in the mid-1970s, it was closer to 40-1. So they started accumulating. Not just a little bit, massive quantities. By 1974, they controlled tens of millions of ounces, stored in heavily guarded facilities in Switzerland. Now here's where it gets interesting. The Hunt brothers weren't just buying physical silver, they were using something called futures contracts, essentially betting on future silver prices with borrowed money. This gave them massive leverage. They could control huge amounts of silver without actually having to pay for all of it up front. Between 1973 and 1979, the price of silver climbed from around $2 to $6 per ounce. Not bad, right? But the Hunt brothers weren't satisfied. They had a more ambitious plan to corner the entire market. A corner strategy means accumulating so much of a commodity that you effectively control the supply. When other traders need to fulfill their contracts, they have to come to you, and you can name your price. By early 1979, things were accelerating. The Hunt brothers formed partnerships with wealthy Middle Eastern investors who shared their concerns about dollar devaluation. Together, they were estimated to hold over 100 million troy ounces of silver, roughly 1/3 of the entire world's private silver supply. Think about that for a moment. Two brothers and their partners controlled more silver than most governments. Tiffany & Co., the famous jewelry company, was so alarmed that on March 26, 1980, they took out a full-page ad in the New York Times. The ad read, "We think it is unconscionable for anyone to hoard several billion, yes, $billion worth of silver, and thus drive the price up so high that others must pay artificially high prices for articles made of silver." That's how desperate things had gotten. Luxury jewelry companies were publicly condemning the Hunt brothers. And the price kept climbing. On January 18, 1980, silver reached an all-time high of $49.45 per ounce. That's an increase of over 700% from January 1979. In just 12 months, the Hunt brothers' holdings had gone from roughly $1 billion to over $4.5 billion. That's equivalent to about $15 billion in today's money. But there was a problem. Most of that wealth was on paper. The Hunt brothers had borrowed heavily to finance their purchases, over $1 billion from more than 20 banks and brokerage houses. They were leveraged to the hilt, and the regulators were getting nervous. The U.S. government and commodity exchanges had been watching the Hunt brothers with increasing alarm. This wasn't just about silver prices. This was about Middle Eastern investors potentially controlling a strategic commodity. Remember, this was just a few years after OPEC's oil embargo had crippled the U.S. economy. The idea of foreign investors, backed by oil wealth, dominating another critical market, that was unacceptable. On January 7, 1980, the COMEX exchange, the main silver trading platform, made a dramatic move. They implemented something called Silver Rule 7, which placed heavy restrictions on buying silver futures contracts on margin. Translation? The Hunt brothers could no longer use borrowed money to expand their position. In fact, the new rules made it nearly impossible for anyone to take large leveraged positions in silver. Then they went further. COMEX capped the maximum futures position at 3 million ounces per trader. The Hunt brothers controlled far more than that. They were suddenly in violation of the new rules that didn't exist when they started their strategy. Now think about the psychology of what happened next. When you're running a corner strategy, You need prices to keep rising. That's how you profit. And more importantly, that's how you meet your margin requirements on all those borrowed funds. But once the exchange changed the rules, new buying dried up instantly. The massive demand that had been pushing prices higher suddenly vanished. And here's the brutal reality of leverage trading. What goes up can come down much, much faster. Silver peaked at $50 in mid-January 1980. By late March, it had collapsed to below $11 per ounce. The Hunt brothers lost over 50% of their paper wealth in just 4 days. On March 27, 1980, Silver Thursday, the Hunt brothers received a margin call for $100 million. A margin call is essentially your broker saying, hey, you need to deposit more money right now, or we're going to liquidate your positions. But the Hunt brothers couldn't pay. They were in too deep. Their total losses were approaching $1.7 billion. And remember, most of that was borrowed money. The panic wasn't confined to silver markets. Wall Street was terrified. If the Hunt brothers defaulted, it could bring down multiple major banks and brokerage firms. The fear of systemic collapse was real enough that a consortium of U.S. banks had to provide an emergency $1.1 billion line of credit to keep the brothers afloat and prevent a broader financial crisis. Think about that for a moment. The financial system came within hours of a catastrophic collapse, all because two billionaires tried to corner the silver market. It was a warning shot about the dangers of extreme leverage and market manipulation. The aftermath was brutal. The Hunt brothers were charged by the Commodity Futures Trading Commission with manipulating silver prices. In 1988, they were ordered to pay $134 million in damages. By September 1988, both brothers had filed for bankruptcy. Nelson Bunker Hunt, who had been worth an estimated $16 billion in the 1960s, emerged from bankruptcy with less than $10 million to his name. His legendary 500-horse stable was sold off. His art collection dispersed. His fortune obliterated. And silver? The metal that had briefly touched $50 per ounce in 1980. It spent the next 3 decades trading between $5 and $20. The Hunt brothers' spectacular failure seemed to prove that silver was just too volatile, too manipulated, too dangerous for serious investors. The consensus became clear. Silver was dead money, a relic, a cautionary tale about the dangers of commodity speculation. But that consensus was about to be proven spectacularly wrong. Fast forward to 2008, the global financial crisis is unfolding. Lehman Brothers has collapsed, Bear Stearns is gone, and JPMorgan Chase, one of America's largest banks, is about to start one of the longest-running manipulation schemes in commodity market history. Between 2008 and 2016, traders on JPMorgan's precious metals desk in New York, London, and Singapore engaged in something called spoofing. Here's how it works. You place large buy or sell orders that you have absolutely no intention of executing. These fake orders create a false impression of supply or demand. Other traders see what looks like massive buying or selling pressure and adjust their behavior accordingly. Then, at the last second, you cancel your fake orders and profit from the price movement you just created. It's basically a high-tech version of market manipulation, and it's completely illegal. JPMorgan's traders did this hundreds of thousands of times across gold, silver, platinum, and palladium markets. They weren't just spoofing occasionally. This was systematic, deliberate, and incredibly profitable. Internal surveillance systems at JPMorgan caught the manipulation multiple times. The CME exchange raised concerns. The CFTC started asking questions. And JPMorgan's response? They misled regulators during the early stages of the investigation. The scale of this operation was staggering. According to court documents, JPMorgan's traders placed tens of thousands of spoof orders, injecting false information into markets to deceive other participants. And unlike the Hunt brothers, who were trying to push prices up, JPMorgan's strategy was more sophisticated. They profited from volatility in both directions, pushing prices up and down depending on their positions. In September 2020, the hammer finally came down. JPMorgan agreed to pay $920 million to settle charges with the Department of Justice, the CFTC, and the SEC. That is the largest penalty ever imposed for spoofing, including $312 million in restitution to harmed investors, $172 million in disgorgement of ill-gotten gains, and over $436 million in civil penalties. Several individual traders were criminally convicted. John Edmonds, a precious metals trader, pleaded guilty to commodities fraud and conspiracy. Christian Truns pleaded guilty to conspiracy to engage in spoofing. Michael Nowak, the head of JPMorgan's precious metals desk, and 2 other senior traders were charged with racketeering conspiracy, the same legal framework used to prosecute organized crime families. The CFTC's chairman at the time didn't mince words. Spoofing is illegal, pure and simple. This record-setting enforcement action demonstrates the CFTC's commitment to being tough on those who intentionally break our rules, no matter who they are. But here's what's really interesting. While JPMorgan was paying nearly $1 billion in fines for manipulating silver prices downward, they were simultaneously accumulating massive physical silver holdings. By some estimates, JPMorgan accumulated over 200 million ounces of physical silver, more than the Hunt brothers ever held, while their trading desk was actively suppressing prices. Think about the brilliance and the audacity of that strategy. Use paper markets to drive prices down while buying physical metal at artificially low prices. Then, when the manipulation is exposed and prices eventually recover, your physical holdings skyrocket in value. It's a scheme that would make even the Hunt brothers jealous. So after decades of manipulation attempts, failed corners, and regulatory crackdowns, silver should be dead, right? The metal should be worthless, discredited, abandoned by serious investors. That's certainly what it looked like through most of the 2000s and 2010s. But something extraordinary started happening around 2020. And it had nothing to do with speculators or billionaire traders. It had everything to do with technology. Let me give you some numbers that will blow your mind. In 2014, the solar energy sector accounted for only 11% of total silver demand. By 2024, that number had jumped to 29%. According to the Silver Institute, industrial fabrication demand hit a record 680.5 million ounces in 2024, and it's still climbing. Why? Because silver has a unique physical property. It's the most electrically conductive metal on Earth at room temperature. Nothing comes close. Not gold, not copper, not aluminum. When you need maximum electrical efficiency, there's simply no substitute for silver. And 3 massive technological trends are converging right now, all of which require enormous amounts of silver. First, the solar energy revolution. Global solar capacity has increased more than tenfold since 2013. China alone accounted for 51% of that growth, adding hundreds of gigawatts of solar panels, and every single panel requires silver paste for its photovoltaic cells. The International Energy Agency forecasts that solar capacity will expand by another 3,200 to 4,400 gigawatts by 2030. Each gigawatt requires approximately 10 to 14 tons of silver. Second, electric vehicles. A traditional internal combustion engine car uses about 15 grams of silver. An electric vehicle uses 25 to 50 grams, up to 79% more. With global EV production expected to triple by 2030, automotive silver demand could exceed 100 million ounces annually. Third, artificial intelligence and data centers. Here's a stat that should terrify anyone betting against silver. AT power capacity increased by 5,252% between 2000 and 2025. AI alone is expected to see 33% annual growth in electricity demand over the next 4 years. And how are tech companies powering these massive data centers? Increasingly with solar energy, which means more silver. The result? For the first time in decades, we're seeing genuine, structural, non-speculative demand for silver that isn't driven by manipulation or corner strategies. Industrial users actually need this metal. They're not buying it to corner markets or make quick profits. They're buying it because they literally cannot build their products without it. Now here's where the story gets really interesting. While demand has been exploding, supply has been going in the opposite direction. Global silver mine production peaked in 2016 at about 900 million ounces. By 2025, production had fallen to approximately 835 million ounces, a 7% decline. And here's the kicker. Roughly 71% of mined silver comes as a byproduct from polymetallic gold, lead, zinc, and copper mines. What does that mean? It means that even if silver prices double or triple, production won't necessarily increase much, because mining companies aren't digging for silver. They're digging for copper or zinc, and silver just happens to come along for the ride. Higher silver prices don't automatically incentivize more silver mining the way they would for a primary metal. The numbers are stark. Total silver demand in 2024 reached 1.24 billion ounces. Supply? About 835 million ounces from mines, plus recycling. That's a deficit of approximately 117.6 million ounces, equivalent to roughly 10 months of global mine production. And it's not a one-year anomaly. 2025 marks the 5th consecutive year of supply deficits. The cumulative shortfall from 2021 to 2025 totals 820 million ounces. Basically, an entire year of global production that simply disappeared from the market. Where did it go? Into solar panels that are now on rooftops across China, Europe, and North America. Into electric vehicles driving around California and Norway. Into servers powering ChatGPT and other AI systems. Unlike financial speculation, which can reverse instantly, industrial consumption is permanent. Once silver is embedded in a solar panel on your roof, it's not coming back to market for 25 years. The physical markets are feeling the squeeze. London's silver vaults, traditionally the world's largest hub for silver storage, held 31,023 metric tons in June 2022. By March 2025, that had plummeted to 22,126 metric tons. That's a one-third decline in less than 3 years. Traders reported borrowing costs that hit 200% on an annualized basis for overnight silver loans. That's not a typo. 200% to borrow silver overnight. That's the kind of rate you see when there's an acute shortage of physical metal. India, the world's largest consumer of silver jewelry and the second largest overall consumer, imports 80% of its silver supply. When tariff uncertainty hit in 2025, some traders were chartering planes, yes, actual aircraft, to transport silver because they couldn't risk delays with cargo ships. That's desperation-level behavior. All of this set the stage for what happened in 2025. And let me tell you, it was spectacular. Silver started the year trading around $30 per ounce. By mid-December, it had smashed through $65, an increase of over 120% in less than 12 months. On November 26, 2025, silver hit $53.14, a 76.51% increase year over year. But here's what makes this rally different from the Hunt brothers' manipulation in 1980. This was not driven by speculation or leverage. This was driven by a genuine supply-demand imbalance combined with macroeconomic factors. First, the Federal Reserve started cutting interest rates in late 2024, making non-interest-bearing assets like precious metals more attractive. Second, geopolitical uncertainty was spiking. Wars in Ukraine and the Middle East, U.S.-China tensions over Taiwan and technology, political instability across Europe and Latin America. Third, tariff policies announced in 2025 created supply chain anxiety, pushing companies and countries to secure physical stockpiles of strategic materials, including silver. Investment demand exploded. Silver exchange-traded products absorbed 95 million ounces in the first half of 2025 alone. Physical purchases by retail investors surged. Between 2010 and 2024, U.S. retail investors alone purchased a staggering 1.5 billion ounces. That's 46,000 to 160 tons of physical silver. In India, cumulative retail demand reached 840 million ounces. In Germany, annual demand hit 48.5 million ounces. Australia saw a record demand of 20.7 million ounces in 2022. Major financial analysts started revising their forecasts upward. Metals Focus projected silver could breach $60 by late 2026. Some analysts were even more bullish, suggesting silver could hit $95 or higher if supply deficits persisted and the clean energy transition accelerated. But perhaps the most significant development was this. In 2025, the United States government officially added silver to its critical minerals list. Think about what that means. Silver is no longer just a precious metal or an industrial commodity. It's now classified as a strategic resource essential to national security, on par with rare earth elements and lithium. Why? Because without silver, you can't build solar panels at scale. You can't manufacture advanced electronics. You can't produce cutting-edge military equipment. You can't power the AI infrastructure that's becoming central to economic and military competitiveness. Silver has become indispensable to the modern economy in a way that even gold isn't. So let's return to our original question. Why did attempts to kill silver fail so miserably? The Hunt brothers tried to corner the market through accumulation and leverage. They failed because they underestimated three things: how much supply would flood into the market at high prices, how quickly demand would collapse, and most importantly, how hard regulators would fight back when a strategic commodity came under the control of private speculators backed by foreign oil money. JPMorgan tried a different approach: suppress prices through systematic spoofing while accumulating physical holdings. They paid nearly $1 billion in fines, several traders went to prison, and the bank's reputation was severely damaged. But here's the irony. If JPMorgan did indeed accumulate massive physical silver holdings during their manipulation period, those holdings have now appreciated massively as prices surged to record highs in 2025. But the fundamental reason manipulation failed is this: you can't manipulate away genuine supply-demand fundamentals indefinitely. The Hunt brothers discovered this in 1980 when their leverage collapsed. JPMorgan discovered this when regulatory scrutiny forced them to settle. And anyone trying to manipulate silver markets in 2025 and beyond will discover the same thing. Because here's the reality: the world needs silver, not for speculation, not for financial gamesmanship, but for the actual technological infrastructure of the 21st century. When solar panel manufacturers need silver to meet renewable energy mandates, they'll pay whatever price is necessary. When EV makers need silver for battery management systems, they'll secure supply regardless of cost. When AI companies need silver for the data centers powering their models, price becomes secondary to availability. This is the critical difference between 1980 and 2025. In 1980, silver demand was primarily jewelry, photography, and minor industrial uses, all of which could be reduced or substituted when prices got too high. Tiffany's complained about silver prices, but they could switch to other materials or reduce their silver jewelry lines. Today, solar panel manufacturers can reduce silver content per panel through thrifting techniques, and they are. Silver loading has dropped from 22 milligrams per watt to around 10 milligrams in advanced cells. But they can't eliminate silver entirely. The physics won't allow it. Silver's electrical conductivity is irreplaceable for current photovoltaic technology. Research into copper metallization as a substitute has been ongoing for over a decade, and commercial viability only arrived in 2023 and 2024. Even if adoption accelerates, it'll take years to scale, and it won't work for all panel types. The same goes for electric vehicles, electronics, and AI infrastructure. You can reduce silver content, but you can't eliminate it. And as global production of these technologies accelerates, even reduced silver content per unit still means massive total consumption. So where do we go from here? Let's look at the facts without speculation. The structural deficit in silver markets is projected to continue through at least 2026, possibly longer. With demand forecast to exceed 1.2 billion ounces annually and mine supply stuck around 835 million ounces, the math simply doesn't work without continued drawdowns of above-ground stockpiles. Multiple analysts project silver prices could reach $70 to $95 per ounce by 2026-2027 if current trends continue. Some more aggressive forecasts even suggest prices above $150 if supply constraints worsen or if investment demand accelerates beyond current levels. These aren't fringe predictions. They're coming from major commodities research firms and institutional investors. But here's what's most important to understand. Silver has fundamentally changed its role in the global economy. For most of human history, silver was primarily money, a store of value and medium of exchange. From roughly 1900 to 2000, it transitioned to being primarily industrial, used in photography, electronics, and jewelry. But it was still relatively substitutable. Now, in 2025, silver has become something else entirely, a critical strategic resource for the clean energy transition and the digital economy. It's not just valuable. It's irreplaceable for key technologies that governments worldwide have mandated as essential to energy security, climate goals, and economic competitiveness. That's why manipulation ultimately failed. The Hunt brothers tried to corner silver when it was primarily a monetary metal, and the government shut them down because it threatened financial stability. JPMorgan tried to suppress silver when it was transitioning to an industrial metal, and they paid $1 billion in fines while the physical market continued tightening regardless of paper market manipulation. But you can't manipulate away the reality that China needs silver to meet its renewable energy targets. You can't manipulate away the fact that every major economy has committed to massive solar build-outs over the next decade. You can't manipulate away the physics that makes silver the most electrically conductive metal on Earth. The attempts to kill silver, whether through market corners, regulatory crackdowns, or price suppression schemes, all failed for the same ultimate reason. They were fighting against technological and economic realities that no amount of financial engineering could overcome. Silver survived the Hunt brothers. It survived decades of price suppression and manipulation. It survived being written off as dead money. And now, in 2025, it's not just surviving, it's thriving in a way that even silver bulls from a decade ago would not have predicted. The metal that two Texan billionaires tried to corner, the metal that JPMorgan manipulated for 8 years, the metal that supposedly died in 1980. That metal is now hitting record highs and being recognized as critical to the future of energy, transportation, and technology. They tried to kill silver, and they failed, miserably. Because you can't kill something the world genuinely needs, and as it turns out, the world needs silver now more than ever. The story of silver is ultimately a story about the limits of manipulation, the power of genuine demand, and the way technological change can completely transform a market's fundamentals. It's a reminder that while financial games can move prices in the short term, long-term value comes from real-world utility. For investors, the lesson is clear. Speculation and manipulation can create volatility, but sustainable bull markets are built on genuine supply-demand fundamentals. The Hunt brothers' manipulation created a spectacular bubble that collapsed catastrophically. JPMorgan's suppression scheme couldn't prevent the underlying tightening of physical markets. But the current silver rally, driven by solar energy, electric vehicles, and AI infrastructure, is based on actual consumption that can't be easily reversed. Whether silver reaches $70, $95, or even higher in the coming years remains to be seen. What's certain is this: the metal that was supposed to be dead has come roaring back. And the forces driving that comeback, the clean energy transition, electrification of transportation, and digital transformation of the economy, aren't going away. The next chapter in silver's story is being written right now. And based on everything we've seen, It's going to be far more interesting than anything the Hunt brothers or JPMorgan could have imagined.